Hello, everybody. My name is MJ the Tutor, and you are listening to Accounting Makes Sense, an MJ the Tutor podcast. This podcast focuses on helping accounting students all over the world by offering a quick warm-up on various accounting and business topics that hopefully leads to the generation of bigger discussions and conversation. So, as a continuation of the series that we've been doing, or we started last episode, this is the second episode of that series, which is on consolidated group accounts. For today, I'd like us to cover intra-group trading or transactions in more detail. This is, of course, a topic that's fundamental to understanding how group financial statements work, but can also be a major source of confusion for a lot of students. We'll try and go through what it is, the key accounting adjustments we make in these kinds of transactions, and why it matters in real life. So if you've ever found yourself wondering why companies eliminate certain transactions when consolidating their financial statements, this episode is for you. So let's dive in. First question, what is intra-group trading? Simply put, this is where companies within the same corporate group buy and sell goods and services between each other. Think about it like a mini market, and each individual company within the group could be a buyer or a seller, and they actually trade with each other. So that's what happens in this mini market. Let's take our basic example. We have a parent company, which I'll call Parent Co. at this point, and a subsidiary, which is Subco. So the Parent Co. maybe manufactures a product, and Subco sells these products to the customers themselves. If Parent Co. sells this product to Subco, that's an intra-group transaction. On the surface, this seems straightforward, right? You have one buyer, one seller, and things are running smoothly. But here's where things get tricky. When you consolidate financial statements where your buyer and seller are in the same place or in the same group, the group then treats this whole relationship as a single entity. That means any profit that hasn't been realized outside the group can't be included in the final numbers. So, are we getting confused? Let's try and dive into that deeper. What does that comment mean? You see, when a company within a group, like here, the parent company, sells goods or services to another company within the same group, here, Subco, any profit on that transaction is considered unrealized or not realized yet until those goods and services are actually sold to an external party, so outside the group, somebody like a major customer or external customer. Since consolidation presents the group as a single economic entity, the group cannot recognize profits from internal transactions because the group as a whole has not yet earned that profit from an external party. Which brings us to the challenge of how do we actually account for these transactions properly. Here are the accounting challenges faced when we are trying to work out intragroup transactions. The issue is that intragroup transactions can inflate revenue and profits if they're not adjusted properly. That's the most common problem. It's the unrealized profits. So let's continue with our example that we've given earlier. So Parent Co. was actually selling this product to Subco, and let's say they've sold it for $10,000, okay, with a 20% markup from cost, meaning that Parent Co. is going to earn profits from this sale. That means the original cost is $8,000 for Parent Co., and Parent Co. will then record a profit of $2,000 from that sale. So on the other end, Subco now bought these products, but at year end, the group still owns this product at year end. Because the sale happened within the group and that $2,000 profit is actually recorded on the parent company's books, but you haven't really realized it yet because you haven't really sold this product outside the group, we have to eliminate the $2,000. You have to eliminate the profit because if you leave it in, you are actually inflating the revenue of one side, right? You're inflating it, showing that you've made a profit somewhere when you haven't really made this profit yet. In simple terms, as mentioned, if the group still holds that product, any profit made within the group is still floating around. It's not earned, it's not realized from an external customer. So what are the key adjustments we make here? We firstly do elimination of intra-group sales and purchases in the consolidated statement. Number 2, we remove any unrealized profit that is sitting in closing inventory or closing stock. This might sound a bit tedious, okay? And the point is just to ensure that we're not double counting profits and inflating the group's financial performance anywhere. So let's look at a practical walkthrough. So let's break this down further with the actual example we had earlier. We had Parent Co. selling inventory of $10,000 to Subco. The cost of the inventory is $8,000. Parent Co. will record $2,000 profit. Now, by the end of the year, let's say Subco still has half of that inventory in stock. So that means $5,000 worth of purchases remain unsold. Okay, so at the group level, the adjustment would involve eliminating the intra-group sales and purchases. So you actually remove the $10,000 revenue and the corresponding purchasing entry on the Subco books. The second one, you would then adjust for the unrealized profit, which here we're talking about half of the inventory is still on hand. We need to actually remove half of that $2,000 profit, which is $1,000 in this case. So this reduces your inventory value on the consolidated balance sheet. So the process, you can see, it ensures that the financial statements reflect only the profits that you've really realized from external parties. It doesn't actually include that portion that has not been sold. So you might be wondering, why does this matter? Improper treatment of intra-group transactions can distort financial statements and mislead stakeholders. And that's always one of the key things when we are looking at these kinds of transactions. It's to ensure that the financial statements show a true status of the company, financial status of the company, and any kinds of transactions that could be ambiguous or misleading should not be on the financial statements. It should actually be dealt with. If intra-group sales aren't eliminated, revenue and profits could be artificially inflated, making the company appear more profitable than it actually is. So this is really a serious issue when it comes to financial reporting, especially your integrity, right? You're causing concerns among your auditors and investors because the investors will look at it and say, hey, this is actually a very good company. They actually are, profitable, more profitable than they should be. And so that is kind of the thing. For example, as well, your regulators and your analysts often scrutinize companies whether they are actually doing proper elimination of these intragroup transactions, because if they aren't, it can lead to financial restatements, reputational damage, and even legal consequences. So what are the common student questions that we get for this? First one, if the sale actually happened, why do we have to eliminate the transaction? And this is actually a good question because we're looking at it as a group rather than as an individual company. That's actually why we do it. The group hasn't earned that revenue until it sells to an external customer, hence why we eliminate it. Second, what happens if the inventory is eventually sold? In our example, we had half of the inventory still in the books, and ultimately, sometime afterwards, we actually eventually sell it. So once Subco sells the inventory to an external customer, that unrealized profit from the earlier portion, okay, the ones that we try to eliminate, now becomes realized. And now we can actually then recognize it as a profit in the next period. Third question, do intragroup services follow the same rules? So we've talked a lot about products and goods and all that, although you probably have picked up, I tried to incorporate its goods and services rather than just goods. But our example was mainly focused on goods and inventory and products. What happens when it's a service? Does it follow the same rules? And the thing there is yes and no, because it doesn't involve inventory. It can be that there's no inventory on hand. There's no closing stock. So you'll see that when we're eliminating it, that's how we do it, right? We eliminate the profit on the closing stock. But if there's no stock really, physical stock, what happens there? So yeah, intra-group charges for, let's say, management fees or interest on loans and that kind of thing, they could still be adjusted if they don't reflect the true value or the fair value. So you gotta just be careful about that when you're looking at a different type of intra-group transaction. So maybe more intangible, right? More on the services side of things. So as a key takeaway from today's episode, first thing is intra-group transactions or trading happens all the time, especially when companies in the same group buy and sell to each other. Definitely, you'll have to watch out for these transactions. Number two, transactions like this must be eliminated in consolidation to prevent double counting of revenue and profits. That is one of the main reasons, or definitely a major reason to do this. Number three, unrealized profits. You have to look at that, especially on inventory and products. They must be adjusted to ensure your financial statements reflect only external earnings. And then the fourth key takeaway, think about it as not just an accounting technicality. It has real-world implications for financial reporting, for transparency of corporations. Anyway, that is it for me today. I hope you have enjoyed today's episode. I am your host, MJ the Tutor. Thank you for joining me, and I'll see you again next time. If you found this helpful, please be sure to subscribe or follow to catch the release of the next episode. You can also connect with me on various social media like Facebook, Instagram, X, Threads, BlueSky, YouTube, and definitely we have a lot more social media platforms now that we're on, and the handle is MJ the Tutor. You can also visit me on my website, www.mjthetutor.com. Till next time, ciao for now.